A quick look at the disclaimer. All right. D, we had a question today from MW
Yep.
uh, about a lot of single leg trades were taking place, I guess, I think it's ZM
Hmm.
is the stock symbol. He says, I
Okay.
have a question. After doing my weekend research, unfortunately, I'm at work, so I can't get on a Zoom call. I noticed a lot of volume in ZM multi-leg trades this past Friday. Uh,
So multi-leg trades, not.
multi-leg, sorry, multi-leg trades. Yeah.
Yep.
Calls with Delta Head shares it looked like the January 5 way out of the money calls. I was trying to determine why someone would be doing this or if it has a relationship with upcoming earnings.
Okay. So, yeah, and that's a good observation because here we have earnings coming up today after the market close, May 20th after the market close. So that could explain anything in, that there's going to be some surge in trading and volume because that's not unusual. Prior to earnings, we see people positioning themselves or protecting their positions or uh, expressing their viewpoint through the options. But let's just take a look first at the multi-leg trades here. So I'm going to come over here. We're on ZM now, and under options, we have these multi-leg trade analyzers. So when we click on that, this will look through the multi-leg trades in ZM. Now it's looking at, we're not open today, so this is looking at already Friday's activity. So as the end of day, here's May 17th. You could see here, you could go back. But on May 17th, let's look at this filter first report. We see that there were 20,416 contracts that were involved in multi-leg trades and 281 different unique uh, combinations of multi-leg trades. Okay. The top one that we see traded 10,524, and our analyzer said that it, looking at it, it could be two different strategies, more likely a modified iron condor or double vertical. We'll take a look at that. The next one down, there are 2,950 contracts involved in call spreads and 37 different types of unique call spreads, because a call spread, we could have different expirations, different strikes. So 37 unique combinations. Then we had that call with Delta Hedge. So the question was with the call spread, Will?
Yes.
Okay.
Well, he said multi-leg. He didn't say call spread he actually asked. It seemed like there were a lot of out of the money 25 Delta calls that traded.
Can you read the question again?
All right. I have a question after doing my weekend research. Unfortunately, I'm at work, so I noticed a lot of volume in Zoom multi-leg trades from this past Friday. Calls with the Delta Head shares and January 25 way out of the money calls. I was trying to determine why someone would be doing this or if it has a relationship with upcoming earnings.
Okay. So here's the call with the Delta Hedge. I believe that's what he was asking. Right.
That top one was the one. Yes, the multi legs, he says.
Yeah. So on this call with the Delta Hedge, we see three different trades um, from Friday. Um, these are them below. We filter them out at 124.18, 1,495 contracts traded on the June 2175 call. And this had stock tied to it, 23,920 shares of stock. Okay. This particular option has 35 days to expiration. It traded for 73 cents, the option, with the market 73 cents. Here, let me close this just to expand it. 73 cents, 75 cents, with the stock 63.97 at the time of the trade. So let's take a look at that trade because and there are two more. This one had the biggest volume, 1,495. It was a 75 call, so you could see it's out of the money. The stock is $64.16. Okay. I'm going to open this up here for more details. And before we get down to these details, I'm just going to show you guys here what happened. So it looks like that there wasn't a big change in the open interest. So there might be other stuff trading in that option. We'd have to take a look, but I don't see a big change in the open interest, 174 contracts. So that's something just to keep in the back of our mind. We'd have to go look what else may have traded around there. But let me close this for a second. So before I close it, the option itself, you could see traded at 73 cents. Oops, sorry. Option traded at 73 cents. The market went out 74 cents, 82 cents, meaning that the mark to market, the option value was marked at a higher price than where traded. So trade occurred at 73 cents. The market was 74 cents bid, 82 cents offered at the end of the day, meaning that if we use that midpoint, then you could see that the mark to market, which is how options get marked at the end of the day, mark to market till they expire, finished at a higher value than it traded. Okay. Now let's look at the trade itself because this looked like a hedge. So here's the trade at 124.18, 1,495 options. Only one traded. I'm going to open the details here, but we could just go through it. It's traded at 73 cents with the option 73 cents bid, 75 cents ask. The stock price at the time of the trade where we saw was $63.97. It traded on the Philadelphia Stock Exchange. The strategy itself, according to the Black-Scholes model that we're using, okay, the delta of this trade, 1,495, is 23,920 deltas. Okay, that's the delta of the trade based on the Black-Scholes model or binomial model. And keep in mind that also depends on, the inputs that we're using with our interest rates or dividend for the stock and all that. So that's the delta of the trade. And one of the things on this trade was it was tagged that it was a stock contingent. So what we noticed was there's a stock that traded over here with a stock contingent for 23,920 shares. So that matches up the delta, perfect. That would be a delta neutral trade. Okay. The price of the stock, 64.12. Okay, so that's the price that it crossed at, which you could see is above that 63.97. So what could be going on here? What was this trade? What was this trade about? And does it have to do with, perhaps the upcoming earnings, which is today after the market close? Okay. Now, if we look at this trade and we think, okay, what would the end user be perhaps doing here? Um, and why might he be doing this? Okay, so what is he doing? Why, why, why might he be doing this? How did it impact the markets? Is there a trading opportunity? Okay, so over here, this is this is the inference perhaps that we could draw. Earnings are coming up, and what we know is that with earnings, options are going to be at priced at a higher premium because of the earnings event, right? At a higher implied volatility, higher premium because they're pricing in that there's going to be an earnings and a potential catalyst move. We don't know what that move will be, but we do know that the options are going to be priced, to reflect that earnings event. And well, and if nothing happens or if the move is muted, then the option premiums will come in, right? Now, this isn't a particularly, it's not a straddle or particularly, um, large premium, and it's way out of the money. So we're looking at it. Here's the delta of this option 16. So the delta of that option is 16. It's an out of the money win. So with the stock at 64. So what can be happening here is that that in you're selling out of the money wing, you're buying a delta neutral, so you're not putting exactly a buy rate, which would be very more bullish. As a buy rate, you want the stock to go all the way up. And in this inference, I would say, if I had to just guess off what's going on here, is that it's selling premium in front of earnings at a month a little bit further out, right? So you're not looking at the full month, you're looking at a little bit further out month with a bigger vega, doing a delta neutral, which removes the immediate directional bias. But what essentially this strategy is that it would have a bias a little bit towards the upside, okay, because you still want the stock, because you're getting, if you're selling the call and buying stock, what you would want is the stock to slowly drift towards the strike. You don't want it to really, your bias is that it slowly drifts towards the strike, okay, and that the implied volatility comes in. So from the perspective of the end user selling the call, doing the delta neutral, I think it's just, that's what the bias is, that the assumption is that maybe if you're holding it through earnings or all the way till the end, then your outlook is there'll be a slow drift. Okay, slow drift from here, from 64 towards the strike price of 75. All right, from 64 to 75 between now and the expiration. So really, your best scenario is that if you're slow drifting, right, if you're slow drifting towards that strike, or you're gaining on your hedge, where you bought 23,920 shares of stock, and this option that you sold for 75 cents or whatever, 73 cents, will decay, or the implied volatility will come in, and it's not going to potentially gain, that any gain in the option, or might not gain at all, it will not exceed the gains in the stock. All right, so that's so it's a slightly bullish bias with a viewpoint that the implied volatilities will come in and that will decay. All right. So that's assuming that there's no other position on there, or there's no other, if that was just like, and we can't draw that conclusion from the open interest that this was definitely a new position or not hedging something, but that would be just analyzing this trade in isolation. Okay. So that's what it looks like to me. So you could see here's the stock contingent. This is the time and sales for this trade. So you can see here, those stock contingent. This is where it traded 73.75. We could take a look if these are similar. So over here, here's one. You can see the open interest increased 359, 800 contracts. This traded twice yesterday, 400 and 400. So at 154.44, at 144.02. So if we open that up here, it looks like traded at $8, where the ask price was. This was also a stock contingent trade. You could see here, it was a floor trade, so this was negotiated. You could see this is the delta that we had 23,200, which is that's where we saw the contingent trade cross at 154.46. So it could be that this is also spreading off. Let me see what this is in December. So it could be they're spread. If we assume that these two trades were related, which we can't do with conclusion, definitely with conclusion, but if we thought all these were related, or these two, 124, 144, this one looks to me like the order was selling the call and doing a delta neutral. And then this one looks to me like it might have been buying the call and doing a delta neutral, which basically would be a time spread, right? That's what you would essentially be putting on a time spread that's delta neutral. That's how these two would be, except it would be in a ratio, right? But if we looked at this one, May 24th, this could be also maybe part of it. I don't know for sure, but you could make new assumption. You could try to make assumptions, but they could be not related to each other as well. But I think that's the first one. That's what it looks like to me, that looking at it, selling an upside call delta neutral. Meaning you don't want to take that initial direction and probably hedge it along the way. So if you're doing a delta neutral, assumption is that you're probably also going to trade the Black-Scholes model and hedge your deltas and gamma at the end of the day. And this one, same thing here, except in this December, it looks like somebody was buying the call and hedging delta neutral.
That
So
was
hopefully
great,
that
D.
helps. Yeah.
Yeah, no, that was great. We actually had Tiffany, who's new to the Chameleon. Welcome, Tiffany. She had a couple questions. I
Okay.
know we won't be able to get to all of them, but really quickly, she's looking at PANW has earnings.
Okay.
She was asking, what's the quickest way to determine if you're looking to buy a call, the best way to determine calls going into the earnings expire calls that would be expiring on Friday. So she wants to look at short-term calls going into this earnings in PANW. What's the quickest way to do it? Everyone on the chat has given different, from going to trade ideas to trade cards.
Right.
to use in the options calculator. She also wanted to know how to get to the options calculator. Uh,
Okay. Well, I think the first part, if I understood it correctly, was what is the quickest way to find the expiration uh, that would cover earnings? Like this, the
no,
first expiration that covers earnings?
she's looking for call to buy a call going into earnings, and but she wants to do the expiring whatever's expiring on Friday by Friday is the call. She was wondering how do you look at those calls to see which maybe has the highest win rate or whatever.
So, so here's on PNW, we see here there's an earnings on May 20th, right? So that's actually today. That May 17th expiration obviously didn't cover the earnings because that expired Friday. So the next expiration that will cover that earnings is May 24th. That's what this E is over here. So if you click on the May 24th, now you have the different available options, right? On the call side, these are the options chain. This is the options chain. These are all the calls available on the left-hand side. On the right-hand side, these are the different puts available. And if you're looking for what call options are trading like, in the market, here we have the different volumes for each call. So these are the strikes, these are the call bids and offers, and these are the volumes that are traded in each call. So 698, 547, 256 on each strike. So I think maybe, if there's a follow up to that, but this is how I understood the
Well, if
question.
she wanted to look at put one of those calls into the options calculator, how would she do that?
Right. So if you,
Next question was how do you get to the options calculator?
right. So to pull up an individual call, if you hit the options calculator, if you click on the bid or the offer, okay, it will bring up a ticket for that option. So I'm going to click on this offer, 575. When I do that, it brings up buying because you clicked on the offer, buying the May 24th 350 call strike, and it populated the price 575. You could change these here, but it just auto populates on what you click. So then you run an analysis, and then it brings you up all this, the analysis on this call. And here you have all the details from where the market prices are. This is the payout diagram from at expiration from the options profit calculator. We have the theoretical values here, the sensitivity of the option to different Greeks, delta, gamma, vega, theta, rho. And this is the chart of how the option price changed throughout the day. Okay, so you have this kind of in front of you. And then if you wanted to go into more details in here, you just click on here, and then you could go into more details about, this option. If you want to see, the historical, if you wanted to price out this option based on how historically the stock moved, you could do that. Historical distribution, stock distribution. If you want to do it by the IBKR, you can do it there. I'm kind of going quickly through it because we're right up at 9:30.
Yeah, it's the opening bell.
Yeah.
Well, that was great. Hopefully, Tiffany, that's helpful. She did have another question about searching for an out of the money call to sell against stock she owns. So maybe we can go over how to look at buy rights for particular stocks on tomorrow for her. I'll send the question actually over to you, D, so you can see it before tomorrow's show. Awesome
Okay.
job.
All right. Well, yeah, thank you for the questions and stay safe out there. Have a great trading day and hope to see you guys tomorrow.
Trade in peace, everyone. Have a great